Hello, hello. I'm gonna wait till Instagram goes ahead and connects with some of you so that you guys can join me on this live. I have a special guest again today on Thriving Conversations. For those of you who are just checking in with me for the very first time, make sure you show me some love. Show me some love. Give me some hearts. Give me some thumbs up. Let us know that you are here. We are going to be talking all things real estate, you guys. We're going to be talking about what does it look like when you have that piece of real estate and maybe nobody is actually living in the property. Are you actually eligible to write that off on your taxes? We're going to talk about some of those things. I have a special guest, Larry, will be joining me, Larry Pendleton, who is a CPA. I told you guys I'm going to be having all these conversations over the next couple of weeks with our colleagues, our CPAs, our enrolled agents, and our accountants. We're going to be educating the community, educating our followers on what does it look like to make sure that we are doing the right thing when it comes to our taxes. Okay, so for those of you who are actually joining me for the very first time, let me just say thank you, thank you, thank you. Give yourself a big round of applause. So I am excited today because we're talking about real estate. To our real estate investors, we're going to be helping you out. Okay, I am Dr. Cozette M, America's #1 tax and accounting strategist. I work with 6- and 7-figure CEOs to help them manage their funds, you all, to help them understand where they may be leaving money on the table, those key performance indicators, to help them truly understand, are they wasting money? And ultimately, I'm helping them reduce that tax liability. Okay, strategically looking at where's the cash flow? Do we have cash flow projected for the next 16 weeks, 12 weeks? What does that look like? I also work with our tax professionals, enrolled agents, and CPAs, helping them grow, scale, and leverage their firm. All right, we do this by offering continuing education courses through that are allows them to get in IRS hours. We also have resources, tools. I am also a coach, a mentor, to help them really put some infrastructure into their organization. Look at their profit margins. Are they really pricing their services correctly? All right, but enough about me, you guys, because I'll tell you a little bit more a little later on. But I'm going to say hello to everybody who has jumped in. Hey, Dee. Hey, Absolutely. Hey, Nora. Hi, you guys. Thank you so much for joining me. Give me some love. Give me some hearts. I love them. I love them. I love them. Listen, Larry Pendleton will be joining me momentarily. As soon as I see him, we are going to connect together and we are going to jump on in here and have this conversation. As you guys see, I put in the highlight, the header up there. Can we deduct expenses if the rental property is vacant? We're going to answer those questions. We're going to figure out, like, should we put those rental properties, those investment properties, under some type of business formation? What should we be doing? Larry and I are going to answer all those questions for you momentarily. So show me or tell me where you guys are chiming in from. Let me know where you're chiming in from. If you have questions regarding real estate, how you should be writing things off, can you actually write something off? Can you claim something on your return? We want you to put those questions in the thread. We want this to be as interactive as possible. That is why we're here. These thriving conversations are for you guys. We want to educate, we want to empower, and we want to inspire. But we also want you to get those tax returns done because we do not want IRS knocking at your door for any mistakes, any underreporting, any mistakes on those returns. Yes, it could happen, but it shouldn't happen. Okay? So, with that being said, let me see if I can find my guest. I think he is. Let's see. I think there we go. Let me see. Let me make sure. Thank you guys for your patience. Let's see. Did I do it right? All right, I did do it right. Hey, Larry, how you doing?
Hey, how's it going?
Pretty good over here. Now, I'm in California. Where are you at, Larry?
I'm in Virginia, southeastern Virginia.
Ah, okay, Virginia, Virginia. We have a new family member that left California and went to Virginia, and she's freezing her butt off right about now. This is her first winter there, so that's all on her. But thank you so much for agreeing to have this brief conversation with myself as well as our communities. So you guys, this is Larry Pendleton. He is a CPA, and so today we're going to have this very interesting conversation about rental property, about real estate investing, real estate agents. We're going to just take a deep dive and let you guys know what are some of the things that you can legally and ethically do with this thing called taxes. How can you save money? How can you invest? What about those properties that we flip? So, Larry, before I just get off on the tangent, why don't you go ahead, tell the folks who you are, what you do, who you actually serve, and whatever else you want to share in this brief moment.
I appreciate that. Yes, Larry Pendleton. I've been a CPA for over a decade now, in the public and private spaces as well. My firm is PC Financial Services with my partner Terry Conyers. We primarily service other professionals in real estate, and I say other because we're also investors ourselves. Terry is a Class A contractor. We also own rental properties, short-term rentals, long-term rentals, corporate housing. We do flips. So we just thought it'd be best to just serve those who are in the same industry that we're in.
All right. So let's go on and have this conversation. As an investor, what are some of the things that anyone who's actually, I want to have a conversation about what are some of the things they need to look out for if they want to invest before they even, as it relates to taxes, all of that. What do they need to do first?
Primarily to know like what type of investing you're getting into, whether it's flips or you're going to be an agent or you're going to be a buy and hold investor, because you'll have some investors that say flipping isn't really investing because it's so transactional. But it's important to know the difference between if you're going to be transactional with the sales side of things, or if you're renting out, because the income is taxed differently from that standpoint, and you're limited to certain deductions depending on which side of the fence that you're going to be on. So, and there are certain strategies that we typically set up, whether it's just helping with recommending any structures, if for our wholesalers and our flippers, our agents, our brokers, or for our apartment building investors, we have a separate strategy for them. So it all kind of depends. So it's understanding the industry itself, make sure you're getting a good return, and then, as I tell people, the tax is more supporting the investment strategy that you have in place.
All right. So let's think about this, or let's talk about this. When one has when you're investing and you have several rental properties, is it a good idea to put those properties under your name, or should you set up some type of business formation?
So now we're talking about legal versus like tax implications. Now, from a tax perspective, it doesn't really matter. So if you have a rental property in your personal name, you get the same tax benefits or it's the same tax strategy, whether or not it's in LLC from there. Now, and the flip side of that is that we don't want rental properties in corporations, S corps, or C corps, because it creates some back end like some taxation on the back end when we're talking about estate planning. Passing down properties to heirs or children from that standpoint. So from a tax perspective, it doesn't really matter if you have it in an LLC or not. We just want to avoid it being in a corporation. But from a legality standpoint, you most likely want that limited liability that an LLC can provide from that perspective. So like I said, that's why we like working with other investors, because like we're ingrained to just knowing, okay, which one is best. And then here's the tax strategy that goes with it. So you're just not jumping into random entities and don't really understand why.
Right. So as an investor or someone that has multiple rental properties, or someone that's even considering let's talk about some of the things that you and I know that they are eligible to write off as an investor.
Mm.
And we're not talking about those of you that may own just one home. We're not talking about your Schedule A. We're talking about investing. You have multiple pieces of property, assets that you are either flipping or you have some wear and tear. So you're spending some money on upgrades. What are some of those deductions that they can take advantage of, Larry?
Yeah, so when you're talking about rental properties themselves, it's the mortgage interest that you can take advantage of deducting. A lot of people get mixed up on the entire mortgage payment. That's not so much that's not the case there. As I tell people, you can't deduct the principal payments because you don't want the loan to be be taxable income. So if it's not taxable on that end, then the principal balance, the repayment of the loan is not. But the interest, the taxes, the insurance, all kind of key factors if you're involved with the property itself, repairs and maintenance. But if you're in a short-term rental space, your cleaning ladies and all of that. Even if you're doing a home equity line of credit from your personal home, even though the interest isn't deductible on your Schedule A, if you are using those funds from your rental property, that is now the interest on that HELOC is now a business expense itself. But the key aspect when it comes to rental properties is depreciation. Like that's really the golden card when it comes to deductions, because you may be buying a property for however $100,000. I'm just throwing out numbers right now. You're only putting 15-20% down, if that, from that standpoint, but you actually be able to deduct the value of the building over an extended period of time. Now, if it's on land, you can't deduct land because land doesn't depreciate, but the building itself and certain repairs or maintenance items that's being done, that could be deductible and depreciate over a certain period of time as well. So that's where it's like you have this additional deduction that you get, even though you didn't spend money for it. You got this loan for this property, but you're able to recognize it over a certain period of time. And with the 2017 tax changes, with bonus appreciation, depending on how all that factors out, gain and cost segregation study, which is just breaking up the purchase price and the components of the building into different buckets, that will allow for large depreciation to be taken in a given year. Now we're in 2022; it's the last year for 100%. It starts to phase down 20% every year. So, but it's still a critical component of a tax strategy when you're talking about rental properties.
Right.
And this isn't the case when you're talking about flips. Like flips is considered inventory, no different than selling T-shirts at that point. So you can't take depreciation on inventory because the goal is to sell it quickly from there, where investment rental properties are really for a long-term hold.
Right. So let's talk about this real quick. There is a limitation as to how much one can write off on their personal return, the passive income. You want to have that conversation with them. And I asked this question because this hit home a couple of weeks ago. I had a client in which I'm not well, I do know what happened now, but when we look at our modified adjusted gross income and what we can write off on that tax return, can you share what those numbers look like and what they'll be, if you know them for 2022's tax return or what they were in the previous years, what the limitations are, so that one isn't dinged and one doesn't get a notification from the Internal Revenue stating we needed to adjust your tax return because your modified adjusted gross income exceeded the threshold, therefore you owe X amount of dollars. No surprises. So can you just kind of elaborate on that for a second?
Yeah, so when it comes to losses from rental properties, typically people get into rental real estate because they hear about all these tax losses. But there are certain limitations that kind of come into place there. And also keep in mind that even though for most of us who are rental property owners, there's nothing passive about this, the IRS still deems rental real estate as per se passive. Unfortunately, that means any losses that you're creating from your rental properties do not automatically offset your non-passive income, which could be your W-2, any businesses that you're actively involved in from that standpoint. This also goes for businesses that you're passively investing into that. That's all considered passive activity. And if it's creating losses, you will be limited to there. Now, there are certain thresholds that allow where if your AGI or modified MAGI, I should say, is less than $150,000, you could write off up to $25,000. Well, actually, I'm sorry. Yeah, $25,000 of losses against your non-passive income. Now, for every dollar above $100,000, that $25,000 phases down $2 from there. So it really starts off at 100,000. Below that, you get the full benefit of those losses. But then as you go up, once you hit that 150, you're fully phased out and unable to claim those losses unless you're qualifying for other things. Now, I guess before I jump into those, I'm going to make sure I'm addressing your question first because
No,
we
you
can just
are.
start
That's perfect. You answered it just right. I just want to clarify one thing, and correct me if I'm wrong. The 150 is only if you're a single, but if you're married filing jointly, I want to say the number is a little higher. Is that not correct?
Unfortunately, it's the same. And this is a back and forth that I have with clients because I understand their frustration because most of everything with the tax law is based on, okay, if it's single, it's this, if it's married, it's that, and then if it's married filing separate, it falls more to the single. But when it comes to this $150,000 threshold, it's all based like everyone's in the same bucket.
Mm-hmm.
So I definitely understand that frustration if someone's single and getting the, or if you're married but you're limited as if you're single. And
right.
all that's part with the part of the Reagan era when they started putting these passive loss limitations in place so that high net worth individuals don't abuse this benefit that rental real estate typically brings to the table.
Right. So real quick, I want to deviate just for a second, you guys. We are talking all things real estate. We're talking about real estate and taxes. You know, some of the things that you can avoid, some of the tax write-offs that you can use. Of course, I am Dr. Cozette M, America's #1 tax and accounting strategist. We have our guest on this conversation, Thriving Conversations, Larry Pendleton. I need for you guys, what questions do you have? Put them in the thread. I'll make sure to take a moment and go through. But we want to utilize this time to make sure that we are answering questions that you all have as it relates to real estate, taxes, and what you can and cannot do. So don't be shy. Go ahead and put your question in the thread there. If you're too shy, then you can always hit Larry up in his DM, or you can always hit me up in my DM and ask us any questions. But Les, I'm sure if you have a question, your question is the someone else needs to know as well. So drop your questions in the thread for us. One thing I often run into, and I'm sure you have this problem as well, is oftentimes I'll have clients come to me and they say, well, I didn't have a tenant in unit number 10 for the entire year, and I had to pay the mortgage. Can I write that mortgage off as a business expense? Let's elaborate on that. I'm gonna let you answer how you would answer the client's question.
Yeah, I get that question quite a bit, especially with clients who are going through, or even within my own team where we're doing these heavy renovations on our rental properties. But what I try to inform people is not based, like when you hear the term placed in service for your rental property, that's when depreciation starts for the property itself. But placed in service doesn't technically mean someone is in there paying. So if you have this business that you're running and you're actively occurring expenses with this property, even though someone may not be in there, if it's marketed as such, or if it's livable, but just no one's in there yet, there are certain expenses that you could deduct and some expenses that you can't. If it's not in service, that means it's not livable, but you're incurring certain expenses like mortgage interest. Okay, you still incur interest on this investment property that you have. That is still deductible itself. But if you're replacing the whole roof and the property isn't ready to be rented yet, or it's not livable, that roof is considered a capital expenditure and has to be depreciated over a certain period of time. So you're not going to be able to depreciate that right away until the property is actually placed in service. So typically, especially around this time, people are trying to rush to get renovations done and property in service. I'm speaking for personal experience because we just got a short-term rental that we just went live this month with. So we were pushing to get everything up and going there. So, but there's certain expenses, like I say, even if it's not ready to be rented, if you're paying for insurance, you're paying for taxes, you're paying for insurance for the property, you're still able to deduct those type of items. Any kind of small repairs items, even though, like I said, if you just kind of hire a handyman to kind of fix one thing while the major stuff is being done, that's not considered capital expenditure, so you're able to deduct that as well. Make sure you get your 1099s out.
Right. So I do have a question in the thread here about that. Hold on. The good accountant asks, can you explain the different examples of things to be capitalized versus things to expense, and how can they be recognized in the same, or can they be recognized in the same tax year?
Yeah, so the IRS, great question, thank you. The IRS has their tangible property regulations, all that involves, okay, what's considered a repair maintenance item that could be expensed right away versus what is considered a capital expenditure. So your capital expenditure are really your major components that you're doing. The roof, the type of flooring is something to consider, whether it's hardwood floor. If you're doing all of that, you're putting the walls, you're replacing all the windows. But if you're just doing paint, or you're or replacing a small percentage of your windows, or you're just getting a item replace a repair a refrigerator, like those items where you're not replacing a major item is considered repairs and maintenance. But like if you're going from repairing a refrigerator to replacing the refrigerator, that could be considered capital expenditure. It's not that black and white, because now we're talking about the minimum safe harbor regulations, where if it's less than $2,500 at the invoice level, you can actually expense that right away, no questions asked. I mean, I'm not sure how many over $2,500 refrigerators are there, but it's stuff that you really have to consider instead of just, hey, I got this large ticket item, or I have to CapEx this. There's actual additional assessment, whether it's a betterment, adaptation, or restoration of an item as well that has to be considered. I'm going through a lot of the weeds right now, but like at a very high level, I'm going through these weeds. But it's stuff where it's like, okay, you just can't take it at that ground level. There's additional assessment that can be done. I'll go back to the roof example. If you replace the whole roof, that's CapEx, no questions asked. Like that just is what it is.
Right.
But if you replace 10% of the roof, that's an argument that can actually be considered an expense, because you did not replace a major component of the building itself. And these are questions people should be having with their accountants, with their tax advisors, so that you're just not getting. Because what I see a lot is that people just get a lump sum invoice from their contractor.
Right.
I get cursed out a lot when I tell people, like, push back, have them itemize it, because if you give me a $50,000 invoice with no description, I'm gonna have to CapEx that over 27.5 years.
Right.
Which isn't bad, but it's good, but I want great. So if I can actually take 10, 20, 30% of that and be able to expense it or put it in a bonus depreciation bucket, 100% bonus, then like that's a better situation for my client.
Right. Right. So another question, and let me see, someone asked me a question. Yes, this will be live. Whoever requested or asked if we would leave it for you. Yes, it is going to be live. You can go back and look at it. Yes, itemized invoices, the good accountant. So this question is real estate, but what happens when, and this was a real situation, a colleague of ours, a situation when you sell the home. Can you talk about capital gains, capital losses? And then I got another question to follow up to that question, but let's talk about what are the implications when someone is flipping the homes. And let's talk about it from the personal tax return side as well as let's look at it from the business standpoint.
Oh, yeah. So from a flip perspective, part of the reason why we said is treated differently than rental properties. One is depreciation. Two is that the sale of the property does not qualify for capital gains. So the 0, 15, 20% people typically hear about, it typically is based on the individual's tax rate. So if you're flipping properties, that's going to be reported on your Schedule C if it's just all under your personal name or under a single member LLC, and then that income is subject to self-employment tax. The self-employment tax, same thing as FICA, Social Security, Medicare is all interchangeable. It's basically that additional 15.3% that most people typically have been splitting with their employers if they've been W-2 employees in their lifetime at all. But as a self-employed, if you're a flipper, that's what the IRS deems you. You're now responsible for both portions, which totals 15.3. So not only that you have your tax bracket or your effective tax rate that you having to pay on the sale of that on that flip, you actually have to add on an additional 15.3% on top of that. And that's when you hear about people 50, 60% of their income being taxed because of these additional items that they're not aware of from there. Now, from a business perspective, if you're actively involved as a flipper, similar to what I tell my agent, similar to what I tell my wholesalers, similar to what I tell my brokers as well, if your net income on an ongoing basis is going to be at least $50,000, we have to have a serious discussion of if is an S corp election worth the trouble of doing. And what the S corp election is doing is not creating any additional liability protection. So I want to make sure I'm not an attorney that's not creating anything there. You're not legally a S corp. You're just being taxed as such under your LLC. Right. So what that does is take the Schedule C out of your personal tax return and then puts it onto 1120S S corp tax return. And then from there, you're supposed to be paying yourself a reasonable salary. We work with our clients on determining that based off conversation I have with IRS agents and former agents as well, on what's considered reasonable, because it's not black and white in the IRS code. Then you're paying yourself a salary, and then similar to when you have your job, the employer, which is you, pays part, and then the employee, which is also you, pays the other part. Now, you may be thinking you're paying the exact same thing as the Schedule C, but you're not, because let's just say you had $100,000 net income on your personal tax on your personal tax return from your flip. Your minimal tax bill at minimum is going to be $15,000 because that's where that 15.3% is coming in. So we're not even factoring in state and your effective tax rate from the federal side of things. So instead of 15.3% hitting your 100,000, that 100,000 goes onto your S corp tax return, and let's just say you pay yourself $30,000 salary. So that 15.3 is then affecting on that $30,000 and not on the whole 100, which turns out to be roughly around $4,200, if my math is somewhat correct there. So already we're already talking about $10,000-$11,000 of tax savings from making that S corp election for your business just for tax purposes. Remember, this is no legal advice. It doesn't create any. That's always because I get that question a lot. So I just want to make sure I'm being clear that there's no additional legal protection by doing this S corp election there. But the reason why I said at $50,000 because you have to factor in is the cost of filing a S corp tax return. Are you going to do your payroll, or are you going to pay somebody else to do your payroll? So there's additional costs, especially at the state level, of being an employee. Is all of that outweighed by the tax savings? And if not, then it's probably best to stay single LLC and keep it on your Schedule C. But if you're going to grow your business, you're going to be an S corp elect at some point.
That is so true. That is so true. So thanks for that explanation. So let's continue on. And this is actually, like I said, a real live client situation. So mom sold the house. She got straight cash for it. She got a little bit over $1 million. She decided to disperse that to her children in four ways. She kept a little bit for herself. Who's responsible for paying the taxes on that capital gain? And who's responsible?
So
Is she responsible for issuing gosh, what's the right, a gift taxes? Who's responsible?
yeah,
The gift taxes.
so the first level of that is that mom sold the house. Okay, if it was her primary residence, for 2 out of the past 5 years. So it doesn't have to be consecutively 2 years, just out of the past 5 consecutive years, was that her primary home? And you mentioned mom, so I'm assuming dad is not involved or passed away. So we just say is a single mother at this point, past the widow status. She's actually able to not. If she got $1 million, she's actually $250,000 of that is actually tax free to her as part of the home sale exclusion there. So she gets the benefit of that. Now, if she's going to be gifting this money directly to her kids, now we're talking about, okay, all the different income limitations or triggers, I should say, when it comes to gift tax. It's depending on how much is given, how much has been given throughout this time. So there are additional tax implications for just giving money, gifting money to your children from that standpoint there. Now we're talking about trust, is revocable, irrevocable trust. Like I said, now we can start layering the stuff where hopefully before mom decides to sell the house, she is meeting with a state attorney, a tax advisor that can help advise her on, okay, let's not just sell this all out in your name. Let's start to move assets around and do that true estate planning so to help mitigate her tax hit, as well as, okay, maybe just inherit, maybe it doesn't need to be given all the way to the children from that standpoint. So, but initially, let's say she gets a $250,000 like cut off of that, so $750 is what she's responsible for, and then the gift tax to all the children are then responsible for to their particular portions as well, depending on all the past circumstances that I just talked about.
Okay, so I got another question to that. The children are not responsible for. No, and let me retract what I'm about to say. Are the children responsible for reporting that taxable income or for reporting that income?
You know the answer to this. You know it depends. Everything I just said, like, because I say it's never that black and white, as frustrating as people are about it. Because if you just say, hey, I got $100,000, okay, how much over a lifetime have you received? Because that will play a factor. If it's under a certain amount, then maybe nothing to be reported at that point. But if it's over, and I'm drawing a blank for 1 year, I believe it's 15,000 in 1 year. Like that has to be reported because that would have to be accumulated to your entire total. So that if mom does just something like this again and start giving more money,
Right.
gifting more money to the kids, then it all goes into, okay, and most people don't really hit the true gift tax threshold. It's just something to be mindful of as you're making these type of transactions with your children.
Right. So I hope you guys caught on to that, and that was a real life story. I had two individuals this year that, one last year and two this year, where that happened. A large sum of money through a sale of a home. One of the spouses were deceased, and they decided to disperse funds to the children without even thinking about it. Just did the transaction and then thought about it after the fact. That is one reason why we say to you guys, it is so important to have a tax advisor or a CPA and a tax advisor on your side, because these are things that you need to go to him or her about before you make those decisions, because sometimes it's too late after the transaction has been done. You need to be proactive rather than reactive. We have a question here. It says, wait, but not for real estate though. Just to reiterate, never put properties in an S Corp or a C Corp, right? MF
Great.
Porter 59. You want to elaborate on that?
Yeah, it can get mixed up. You don't want to put rental properties in a S corp or C corp. When you're doing flips, yes, you want your flip activity going through a S corp or C corp if it's necessary at that point. Because the purpose of even doing the S corp election is to mitigate the self-employment tax. So if rental income isn't subject to rental income because it's passive, per se passive, it's not subject to self-employment tax. So there's no reason to move rental properties into S corporation. Then the back end effect, because if you ever wanted to pass down properties to children or move into these out, you cannot break a rental property out of an S corp without it being a taxable event. I haven't come across a way of doing it yet. Okay, I'm about to say, unless you about to educate me right now, because I'm gonna let you take over.
No, that's true.
Uh,
So there's another question. Oh, go ahead.
no,
I'm sorry.
that was hopefully that helps clears that up.
Yeah. So there's one more question in here from the Good Accountant. Do you have any additional bookkeeping tips? Is that bookkeeping tips on how to manage the books for real estate investors, the Good Accountant, or can you elaborate a little more?
Yeah. So if you're going to be managing books for real estate investors, especially for those who are buying and selling property, take a good look at the HUD or closing statement. Because typically people just take the purchase price and they do a good job of breaking out the land portion and then depreciating the rest of the building value over whatever certain period of time. That's a good start, but also keep in mind that within the HUD and settlement statement, there are items that can be expensed right away. So like you may be prepaying for property taxes, prepaying for insurance, prepaying for mortgage interest, especially if you're talking about people doing bird strategy with their hard money lenders. So this is stuff where like you don't really want that to be a factor in the basis of the property itself. You want to make sure that's extracted out, and then you're allocating that directly to the expenses as well. So that, and of course I think we talked about it with the repairs and maintenance and getting the detailed itemized invoices from the contractors or handyman to make sure all stuff is tracked accordingly there from that standpoint. And then also, like I say, just be mindful if your client is using expenses for non-business reasons, and especially from a S corp perspective, where they may want to take a distribution from the company itself, like all that's going to be factored into how much they can take out, because if it's above wherever their basis is or how much equity they have in the company at year end, they may have forgotten that they took out all this money throughout the year, and now there's limits how much they can take out the back end if they want to use that money to help pay for taxes.
Right. And you said something real quick and just want to elaborate. I think it's a good idea for all of you, if you're tax professionals, CPAs, whatever, make sure that you always get that HUD statement, because there's a lot of different expenses on there that you can write off. And it's just a good document to have, especially if someone's buying and or selling, you need to have that. There's another question in here from Babs for NFL. This is T. I moved to Maryland and did a will. My attorney told me I didn't need a trust. Why did he tell me that? I was always told to make a trust.
Well, without really knowing your whole situation, I mean, a trust isn't for everybody right away. I know people like to kind of rush into those, but there is a time for it, and there's a time to have both. Along the way, where the will is a lot simpler to set up, get things going, but I mean, unless you're really pressed to get things going or your trust set up from that standpoint, it may not be worth it. But like I said, without truly knowing your whole picture, it's hard to say why he said you shouldn't. Because yes, the trust really more so just going to execute what the will is saying. Yeah. From that standpoint, and then just make sure, okay, if you're doing revocable or irrevocable, because all that has different tax filing and a cost perspective you have to take consideration there. So, but yeah, I would just, I mean, just kind of, as I tell people, don't just have individual meetings with just your attorney and then turn around and have an individual meeting with your tax advisor. Like, bring everybody to the party.
Yep.
Like, is it going to cost you? Yes. But first and foremost, it's a deduction, and it's going to save you money on the back end.
Mm-hmm.
So, and it helps you stop, it helps you prevent you from trying to talk attorney to your tax advisor when you're not an attorney and may not be
Right.
able to clearly break all that stuff out, and vice versa. Not saying that people can't. It's just you hire these people for a reason. You really want them to be talking to know what's best for your situation.
Right. Right. Every situation is different. I can't tell you how many times my client will say, I want to do a Zoom call with my IP attorney and you together, and we'll talk about whatever it is when we get on the call. But yes, joint conversations get the job done. Thank you, Toyonda. I didn't even notice that was you. How you doing? Hopefully you're doing well. So listen, guys, we have been having this conversation, talking about real estate, talking about taxes, talking about flipping property, capital gains, capital losses. What are the thresholds? What you can and what you cannot do. Should you put those businesses into a business formation? What if you attempt to put them in an S corp? What's the cons to that? We talked about that. Is that something that you should be doing? What about the back end? Are you going to be subject to self-employment taxes? You know, when you're an S corp versus when you're an LLC, all of those things. So what we did say is it's not to your advantage, and we know this, to put any type of properties for business purposes into an S corporation. The purpose of the S corporation, one of the main purposes, is to reduce your tax liability by not paying so much in employer taxes. Okay, self-employment taxes. That's what it is. So, are there any other questions? You are welcome. You are so welcome. MF Porter 59, you are welcome. We appreciate it. She said, thank you so much. This has been so rich thus far. We appreciate it. That's what we're here to give you guys, this information to prevent you from having any obstacles with the Internal Revenue Service. As we know, those of us that are in the industry, and you all know as taxpayers yourself, you've heard it, the IRS has beefed up their force, their task force. They're doing more audits on business owners and audits in general. Okay, so you want to make sure that you're doing the right thing. You want to make sure that you have a professional on your team, that financial expert that can help you stay out of trouble with the Internal Revenue Service. But listen, guys, it's all about being proactive. When you get that first inclination, that first thought about, I want to start this business, I think I want to do something, that is the time that you should pick up the phone. It is not the time to rely on these lives. It is not, even though we give you quality, good information, it's still not the time to rely on YouTube or anything like that. You have to invest. And as Larry just said, it is a write-off. It is a tax deduction that you can write off on the back end. So yes. Any other questions out there that we may have missed? Hopefully I got all the questions that are in the thread here. Y'all know I can't see on this thread half the time, but
Okay.
let's see. Can you see the questions too, Larry? No?
We
Oh,
got the
okay.
move from
Oh,
Maryland. We got the C Corp. We got the
okay,
bookkeeping
so you
tip.
can't see them.
Yeah.
Okay. I can't see
So
his
yeah.
face though, because it's all covered up. But listen, guys, I say, Larry, where can they follow you? First of all, where can they follow you?
Yeah. So I have obviously I'm on Instagram. So they can follow me here. I'm on Facebook. Same thing. Larry Pendleton, CPA. LinkedIn as well. Try to keep it simple for the most part. I'll try to throw my link page in here if anybody wants to kind of learn more about investments that I'm in, or just different podcasts and recordings I've been on talking about these same things and more, as well as a book a meeting to kind of learn more about what they're doing and how I can be of value to them.
I love that. You guys heard that. He said if you want to get more information, he's going to put his link down below. It is important that these thriving conversations are truly important. It's all about educating, empowering, and inspiring you guys, keeping you out of trouble. I try to pick the best of the best that come on here and have these conversations with me. And I believe I found Larry on I think you were having an interview, or I saw one of your interviews on, it was either here on your page or either it was on YouTube. But listen, guys, make sure you follow him. Make sure you follow me. We are in the season, and as you know, we'll be having more of these conversations about what you can do to reduce your taxable liability. I can be followed at Cozette M White on all social media outlets. You can find me on YouTube at Dr.Cozette M White. All right, real quick before we go, I just want to remind you guys, Thrive Live is going down May 11th through the 13th in Los Angeles, California. It is a conference designed specifically for my tax professionals, my EAs, as well as my CPAs. Day 0 will be all about gaining or earning your continuing education hours. Day 1, 2, and 3 is all about learning, putting some infrastructures, or helping you guys put some infrastructures, some strategies, some systems, some automation in place so that you are truly growing your business. If you are tired of being stuck, your business is stagnant, then I truly invite you to Thrive Live. All you got to do is click the link in my bio right above us on Instagram for all the information about the conference. All right, Larry, thank you so much for taking time out of your busy day. I know you could have been flipping some property, doing some taxes, getting ready for this upcoming tax season, as we all are, but you took the time to share with the communities that we both have, and I so appreciate you. All right. Thank you, brother.
Thank you. Thank you. Looking forward to helping them. I can be of value going forward.
Absolutely. Take care. Have a good one, and stay warm there because I know it's cold. Take care, okay?
Thank you. Have a good one.
You too. Bye-bye.